tell you that with Mr. Gary Cokins, we've been doing a number of seminars which will really inform you of the importance of management accounting. So that's something that if you see on my backdrop, it says value creation. I think that's the area where management accountants have to work. Mr. Gary Cokins, is a member of IMA USA and has served them with distinction and as the executive in residence. I must also inform you that his love is for the management accounting profession, and he has provided all these seminars without any charge or free of charge, which benefit our members are enjoying, because we are inviting all our members and the others to come for these. And really the COVID-19 pandemic is something that has brought us closer together, because otherwise for the 4 seminars that you did, Gary, you would have had to come 4 times to Sri Lanka. But today we have connected on the Zoom, and we are doing it very, very well. So I think this is something that we should even carry forward to the future. So we have been able to, these seminars have been able to develop the knowledge and realize the importance of cost and management accounting to improve businesses. And as many business people look at maybe their bottom line and cut down expenditure and effectiveness and the productivity. So with those introductory remarks, before we officially present Gary Cokins with the Fellowship of the Institute of Certified Management Accountants of Sri Lanka, I have great pleasure in inviting Dr. Nuwan Gunratna, a fellow member of the CMA, a senior lecturer of the University of Sri Jayawardhanapura, and of course he's currently in the USA. I think it must be quite late at this time, where he went to do his doctorate. And he is one who really told me, and he has been in touch with Gary for a long time, and that we should contact him, as he has agreed to do some seminars for us. So I think, Dr. Nuwan, may I invite you to read the citation for the award of fellowship to Gary Cokins.
Yes, thank you, Professor Atwal. I'm in Australia. All right. Okay, so it gives me the most privilege and immense pleasure to read this citation for Mr. Gary Cokins on behalf of the Institute of Certified Management Accountants of Sri Lanka. For more than 40 years, Mr. Gary Cokins has been recognized as an expert, speaker, and author in performance improvement systems and advanced cost management. He is the founder of analytics-based performance management, an advisory firm located in North Carolina. He received his BSc degree with honors in industrial engineering operational research from Cornell University in 1971. He received his MBA with honors from Northwestern University's Kellogg School of Management in 1974. Gary began his career as a strategic planner with FMC Corporation and subsequently served as financial controller and operations manager with FMC's Link Belt division. In 1981, Gary began his management consulting career, first with Deloitte Consulting, next with KPMG. Next with KPMG, Gary was trained on activity-based costing by Harvard Business School professors Robert S. Kaplan and Robin Cooper. While at KPMG, Gary worked with Dr. David Norton on research that led to the development of famous balanced scorecard. In 1992, Gary headed the National Cost Management Consulting Services for Electronic Data Systems, now part of HP. From 1997 until 2013, Gary was in business development with SAS, a leading provider of enterprise performance management and business analytics software. Gary was the lead author of the acclaimed ABC Managers Premier, sponsored by the Institute of Management Accountants. Gary's second book, Activity-Based Cost Management, Making It Work, was judged by the Harvard Business School Press as read this book first. Gary's third book, Activity-Based Cost Management, an Executive Guide, was ranked #1 in sales volume of 151 similar books on barnesandnoble.com. Gary has written many other books, including Activity-Based Cost Management in Government, Performance Management, Finding the Missing Pieces to Close the Intelligence Gap, Performance Management, Integrating Strategy Execution, Methodologies, Risk and Analytics, Strategic Business Management from Planning to Performance, and Budgeting, Planning, Forecasting in Uncertain Times, and also Predictive Business Analytics. Gary has participated and served on many committees, including CAM1, the Supply Chain Council, the IFAC, the International Federation of Accountants, the Institute of Management Accountants, the AICPA, the American Association of Accountants. Gary also worked with Professor Robert S. Kaplan on IMF ABC Advisory Panel. Gary served the Institute of Management Accountants USA as the IMA Executive in Residence. He has contributed to research, articles, webinars, and provided support for IMA's expansion in many countries, including India. Gary has received many awards and honors. I'm sure I would miss most of them, but let me remind a few. He is the recipient of IMA 2013 Distinguished Member Award, then Baseball Hall of Fame, oldest computer baseball software, I think from his early work at Cornell University. Then CAM1, Robert Bonsack Award for contribution to management accounting. Above all, after 40 years of experience in various industries and settings in management accounting, which is in fact a privilege, Gary believes that he has a responsibility to share his experience with a worldwide community. When Gary first approached me, offering his help to serve the students and professional members in Sri Lanka, I was in fact surprised and humbly privileged. A person of the highest international repute is offering his services, knowledge, and experience without any financial gain, but to fulfill his responsibility of giving back to the society. So it is with great pleasure and pride I would like to congratulate Mr. Gary Cokins on receiving the fellow membership of the Institute of Certified Management Accountants of Sri Lanka, the National Management Accounting Institution in Sri Lanka. Thank you.
Thank you, Dr. Nuwan. Gary, I now have great pleasure in awarding you the fellowship of the Institute of Certified Management Accountants of Sri Lanka, and the certificate is given online, and it says CMA Sri Lanka, Fellow of the Institute of Certified Management Accountants of Sri Lanka, where you have the designations FCMA awarded to Gary Cokins, and of course the certificate that is there. So let me congratulate Gary on the bestowment of the fellowship of the Institute, which I think is something that we are really doing for the contribution that you have made to the management accounting profession. And especially the close links, as Dr. Nuwan mentioned, that you have established with Sri Lanka. So may I now invite some of your close associates who have been there for some time, Mr. A.N. Raman, who's on the advisory council of CMA Sri Lanka. He's a past president of the South Asian Federation of Accountants, and also served on the Professional Accountants in Business Committee of the International Federation of Accountants. So may I now invite Mr. Raman to give his congratulatory remarks, and maybe we can remove the certificate, and you want, okay. Okay, Mr. Raman. You have to unmute. You have to unmute.
Thanks, Professor Lakshman, and good evening to Gary, Hennaya Bandara, Dr. Nuwan, and others. I would like to be apologized by Lakshman for being slow in my delivery when compared to my usual speed, just because I have recovered from a COVID attack very recently, and I am yet to gain my full energy because of that. Having said that, while it is very important for me to welcome Gary to the fraternity of the CMA of Sri Lanka, I would use this opportunity to first of all congratulate Professor Lakshman himself for his fantastic innate ability of spotting eminent personalities like this Gary around the world and bringing them into the fraternity of Sri Lankan management accounting community for the advancement of Sri Lanka as a nation and its economic development. Let me first congratulate you, Lakshman, for this wonderful work, what you have done today of conferring this and inviting Gary to be a part of our journey of CMA in Sri Lanka. Now, let me move on to Gary, my excellent friend for the past more than, I think, 2.5 decades, Gary. I'm sure I met him when I attended one of the ABC conferences, ABC Technologies, those days in US, and from there on, the triangular link between Gary, me, and Robert Kaplan has seen tremendous advancements in a very close friendship with Gary. I'll just quote one comparable illustration what we have in the ancient scriptures of Tamil, that once a very famous poet, he was asked to sing in praise of the Lord. So the poet asked, I would do that, but you first give me 1,000 tongues. With one tongue, I can't praise you. Then God said, okay, you are granted. Now I am giving you the power of 1,000 tongues. Now you sing about me. But now the poet says, with 1,000 tongues, I am only saying, I regret my inability to sing about you because all the 1,000 tongues are not good enough to sing about you. And that is the glory of the Lord. That is the beauty of Gary. In fact, Gary, a similar sounding word called Gehri in Hindi, our language in India, Gehri means depth. So if I slightly modify Gary Cokins to Gehri Cokins, that is the depth of the man's knowledge in cost and management accounting. A fantastic combination of my passion, engineering and cost management and management accounting. The guy's knowledge and depth of the connect between the strategy and operations and the cost and management accounting is just fantastic. I just envy you, Gary, for all this wonderful track record you have. And I am wordless and speechless to explain what you stand for in the domain of cost and management accounting. I only joined Professor in welcoming you to the fraternity of cost and management accounting in Sri Lanka because the caliber and ability and competency of people like you are very much required in this part of the globe, not only in Sri Lanka, but as well as in India. For the simple reason, which very rightly Professor pointed out, the distinction between the financial accounting and which is I am like you, I call it as a compliance accounting, the financial accounting and the management accounting, the distinction has still not sunk in the minds, particularly of the governing bodies. So you have to meet the challenge of enhancing the knowledge of the governing bodies in countries in this part of the globe. I am sure you will face this problem even in other parts of the globe. This is not something peculiar to the South Asian region. Everywhere, the distinction between the financial accounting or the compliance accounting and the cost and management accounting is yet to be understood very clearly. So at this juncture, particularly in this context of very severe pandemic we are going through, the abilities of the cost and management accounting, which it can bring to organizations in building up and maintaining the competitive advantage is just fantastic, whether managing channels profitably or managing and measuring the customers profitably or the product lines or product platforms profitably or introducing environmentally friendly products. The role of cost and management accounting is fantastic. So you now being a part of our Sri Lankan CMA fraternity, I am sure would play a fantastic role in particularly driving the point home to the governing bodies that, hey guys, you now need cost and management accounting never like before. And that is the message which I am sure you would be bringing to the CMA fraternity, not only CMA fraternity, but also to the governing bodies. And definitely, Professor Lakshman, as I know him, would not leave any stone unturned to make this happen. Thanks, Gary, for being a part of us. And I also thank Professor Lakshman Vatawala, in bringing Gary to our fold. And I also thank Noan in playing a very major role in making this happen. Thanks to all of you.
Thank
Sorry
you.
for
Thank you, Mr. Raman. I think I know that you were not too well, but to honor Gary, you really came. So I think Gary, that was really a special, I think, honor that he has given you. Just one that I would like to, before you start on your presentations and the acceptance speech, I will invite our Vice President, Mr. Hennayaka Bandara, to give his congratulatory remarks.
Thank you, Professor. Ladies and gentlemen, good evening to all of you. Success is created by doing the basics to a high standard consistently. And in this context, Mr. Gary, as a founder and owner of the consulting firm, Analytics-Based Performance Management, a thought leader in enterprise performance management, business analytics, advanced cost management, and also as a consultant with Deloitte, KPMG, and long-time active committee member of IMA, he has contributed immensely for the accountancy profession at large for 4 decades. More importantly, being an author of numerous books and articles in the field of cost and management accounting, he was able to make a valuable contribution to the advancement of cost and management accounting techniques in the private and public sector. While appreciating his valuable contributions, let me join with my president and the council to congratulate you for receiving the fellow membership of CMA Sri Lanka. Thank you.
Thank you, Mr. Hennayaka, because Mr. Hennayaka is not only representing CMA, but also the South Asian Federation of Accountants, where he's the vice president. So thank you very much. Now I would invite Gary Cokins to give his acceptance speech and to start with the presentation. Gary, over to you.
Well, Lakshman and everyone, thank you so much. It's a privilege and an honor for me, to basically be acknowledged. I do have a concern, though. My presentation is like 60 minutes or longer, and we've just used 25 minutes, and I'm blushing with all of the kind remarks that you've said. But, many of the people here don't want to hear about me. They want to learn. So let me get going. Because we've taken up some time, there may not be sufficient time for question and answers at the end. So what I suggest is you can directly email me. There's my email address if you have questions. Feel free, any of you listening, to invite me in LinkedIn, but please put a little message. But you can also put your questions in the chat box, and the ICMA team will copy and paste them, put them into a Word document, send it to me, and within 48 hours, I'll answer your questions. So let's get going. This is my slide, but you've already described me. But if you do the math, I'm 71 years old, but I feel like I'm 41 years old. I think careers have much to do with luck and circumstances than being smart and competent. And as was mentioned, my lucky break was in 1988 when KPMG struck a contract with Harvard Business School Professor Robert S. Kaplan to train people, manager or consultants on ABC, activity-based costing. I was recruited from Deloitte. I learned from Dr. Kaplan, implemented it for 5 years, wrote books. The rest is history. So let's get going. Who will benefit from this presentation? Managers who have previously struggled at promoting measurement and reporting product, channel, and customer profitability into their decision support systems. Managers who intend to champion profitability analysis techniques and need a compelling call to action. And the reason I have champion in quotation marks is it's just been my observation that it'd be nice if senior executives would sponsor and support innovations and initiatives. Often they are preoccupied with firefighting or short-term priorities. It's typically managers 1, 2, 3 levels down in the organization chart who are passionate and ask themselves, how long do we want our organization to continue to perpetuate using stale and arcane methods? And they're the ones that will do a proof of concept or a pilot to demonstrate to their colleagues and executives, this is the way to go. So if you're 2, 3 levels down in the organization chart, that's fine. I like lecturing to you. I start all my presentations with this cartoon: drowning in data, but starving for information. You have this poor beleaguered clerk, shoulders hunched, sad, paper all around him. And the supervisor in the doorway to the left is asking him, looks like you've got all the data. What is the holdup? I gave you the request this morning. How come you don't have the answer this afternoon? You know, and some of you may relate to being this person in the chair. The message here is there's a difference between data and information. Data is transactional, but you convert it into information for decisions. I like to start all my presentations with what, so what, then what. So imagine those of you that have not implemented ABC, and that's the majority of you, I know that. Imagine that you do. I say celebrate for one day. You're not done. There'll be so much more information that you'll see about your organization. It will ask the question, what's relevant? So what? Arguably, the most important question is then what? Because all decisions impact the future. And that's where predictive analytics and cost accounting, budgeting, rolling financial forecast come to play. And I've done an earlier webinar for the ICMA on that. I think it's probably archived. You can watch on that. This one's going to focus on customer profitability. So I'm going to start with sort of a primer. We've got to have a foundation of what is activity-based costing. I also want to basically dispel some of your misconceptions that it takes 6 months or a year to build an ABC system and implement it, and it's too complex. I'm going to show you a way to implement it in 3 weeks. Then we'll get to the whole topic of channel and customer profitability. I'll briefly talk about that predictive view, and then a concern at my end, which applies to India and Sri Lanka and all of the countries. What is taking so long for your executives to sponsor and implement these methods? So let's get going. First of all, here's part of the problem with management accounting. Which system do you use? I'm not going to read all of these. You can see that there's a lot of them. But here's the point. Even most cost accountants do not understand what the differences are. But the major message here is they all follow principles. Rules are many, principles are few. And the universal principle of cost accounting is causality, having a cause and effect relationship. And we'll talk about that in a second. Yes, this is one of the books that was referred to me. Now, a little bit of the primer. All costs should directly be charged, but as variety, complexity, and technology increases, more and more costs become indirect and shared. So what I have here is a spectrum from left to right. The highest form of direct costing is project accounting, but it only applies when there are non-repeatable processes and you're building a one-of-a-kind, like a satellite, or in manufacturing, make to order or engineer to order. Once the processes become more repetitive, then we're to the standard costing, with many of you are familiar with, manufacturing, labor reporting standard. I want to be clear, the majority of organizations today, especially in the United States, do not make products. They deliver services, banks, insurance companies. So if you're in a service organization, everything I will talk about today still applies. It's universal. Activity-based costing, I refer to as the poor person's standard costing system. It's actually easier to do than standard costing. But the real message of this slide is allocations at the right. It's bad, cost allocations, and I'll explain why in just a few minutes. So, simple explanation of ABC. Imagine you go to a restaurant with 3 other friends. You order a simple salad. The other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines also feel in a general ledger and standard cost system when the CFO and the accountants allocate those indirect expense, like spreading butter across bread, using factors like in manufacturing, number of labor hours, or in service organizations, number of units or services delivered, square feet, square meters, sales revenue, and so forth. None of those allocation factors reflect the unique consumption that those diverse products and services consumed of the end-to-end business processes and the work activities that belong to them. So if you were to decompose the indirect expense into cost pools, I'll talk accounting here, and assign them, trace and assign them with a cause and effect relationship, you will discover, compared to that traditional butter spreading, in reality, some of the products and services are overcosted and the others must be undercosted because it's a zero-sum error game. And that means the CFO and the accountants are providing flawed and misleading information to their line managers, executives, employee teams, and they're making decisions with this bad information. So the simple definition of activity-based costing is this. It's as if the waiter or waitress brings 4 individual checks. You only pay for what you consumed. Now, the reason there's been interest in ABC in the last 50 years has to do with this diagram. It has the 3 universal components of any organization's expense and cost structure. The indirect expense at the top, commonly called overhead, direct material, and then the recurring labor. And I use recurring labor because, you know, banks, insurance companies, they think direct, oh, that's manufacturing. No, this is for everybody. When you ask people, why is the indirect displacing the direct? They'll say, well, computers, automation, robots, that's secondary. The main reason for this displacement of overhead relative to direct is all organizations have had an increased proliferation of different types of products in manufacturing, more colors, more sizes, more ranges. Banks have more type of a depository accounts, insurance companies, more policies. The point is this: whenever you increase the diversity and variation of the outputs, it just produces complexity. And the complexity causes the need for more and more indirect expense to manage it. So 50 years ago, when the products were homogeneous, just a few of them, not much diversity, all right, the majority of expenses were direct. You could allocate butter spread, the indirect. You wouldn't introduce much error, but that's not the case today. The indirect is substantial. Now, the problem actually begins with this traditional responsibility cost center statement. Every manager on the planet Earth recognizes this statement: salary, equipment, travel. But when managers receive this report, they ask themselves, how much influence do I have about the cost that I can influence and control? And the answer is not much. I always say when managers get this kind of report, they are either happy or sad, but they are rarely any smarter. And it's not that the report is bad. It's just that the data is structurally deficient. It's not structured in a way that can answer the questions. So notice what activity-based costing does is it converts that cost center statement into the middle, the activity view, key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And then it reassigns those activity costs to the right into the products and customers and so forth, service lines, just like the waiter or waitress in the restaurant, based on how much of it is consumed. So what's really happening here is the expenses don't start at the left. The expenses start at the right side of this diagram. The products and customers place demands on the workload in the middle. The workload draws on the spending to the left, and the costs measure the effect in the other direction. So in other words, demands on workflow right to left, costs measure the effect left to right. Rules are many, principles are few. This is the principle of causality. Unfortunately, many CFOs and accountants violate that principle when they butter spread that indirect expense. Now, I've rotated that first slide 90 degrees. It's not as simple as, oh, just take the general ledger expenses, put them into activity pools and trace them to objects. The right side's more realistic because you have support departments that support other support departments that ultimately support the frontline departments that interact with customers or make products. So it must be a multiple stage cost assignment network. So this is a complex diagram. I'll briefly talk about it, but if you want to read a 30-page paper that's in my website, www.garycokins.com, it's free. Go through the tabs. It's from the Institute of Management Accounting Statement of Management Accounting paper I wrote. It's called Implementing ABC. Now, real quickly, what you see is the three universal components of any organization's expense and cost structure. The ledger expenses at the top, which then get traced into the work activities in the middle, and then they eventually pile up at the bottom into the final cost objects, products, services, customers, and business sustaining. Now you need to adjust your thinking. This is not a process flow chart end-to-end, with swim lanes. It's a reassignment network. So if the organization spent, let's say, $2 million or euros or rupees in January, it will be the exact same 2 million in the middle, and they will pile up ultimately into the customers at the bottom and the business sustaining. All of the arrows, think of them as thin straws or wide pipes, where the diameter of the arrow reflects the amount of money flowing through. That's why this reconciles exactly from the bottom to the top. Yeah, from the top to the bottom. Now I want you to look at the two boxes that are going directly to the customers. They're not going to the products. That's below, that's going to be channel distribution, marketing expenses, selling expenses. That's what we'll be talking about here, going all the way to the customers. Business sustaining is a special category. There will be some expenses that have nothing to do with making products or delivering services to customers. Things like the legal department or the accounting department is closing the books. So what we do is we create a cost object called senior management because they're actually we're providing those services to them. The point is, and typically there'll be 10 to 15% of an organization's expenses are business sustaining. You still need to recover them with price to be profitable, but they're just not traceable. The point is this: costing is modeling. Costing is not T accounts and journal entries. You model the inputs to the outputs. Direct cost, that is not broken. You may have data integrity issues, you can solve that. Sometimes people are interested in going to the balance sheet for the cost of capital. You can actually also use an imputed cost of capital for like accounts receivable for customers or inventory. But here's the result. When you do ABC, it becomes the squiggly, the curvy line in this diagram. Now, the vertical axis is the magnitude of the error compared to the butter spreading. The butter spreading is the horizontal line, see, traditional costing. To the left side, we've got basically the overcosted products. They're actually more profitable, but you don't know it. And those are typically the simple products and services. You can think of this like yourself in that restaurant ordering the salad. To the right side, those are the products and services that are more complex that in reality have been undercosted. So you're actually losing more money on them than you think. This is much more relevant. What do you see after you've calculated with ABC? And you're looking at real data here from a real company. The vertical axis is the net revenues minus the properly calculated and traced activity-based costs. The horizontal axis is the cumulative buildup of the product profitability, but it's rank ordered starting with the most profitable product to the second most profitable product and so forth. The very last data point at the end, at the right side, will exactly reconcile with the profit and loss statement. So in this particular company, they had 30 million dollars in revenues, 28 at expenses to net out at 2. And the last data point is exactly the same 2. It's always organizational shock when management sees this slide, this graph, because it basically is saying, look, you made roughly $8 million of unrealized profit based on 3/4 of your most profitable products. And then you lost $6 million on the remainder to net out at 2. And they cannot believe it, because their belief system is that graph is actually this blue line. And the problem is all that butter spreading of the overhead, that broad averages violating the cause and effect relationship, was crushing and suppressing the accuracy. And the top line was detecting all the unique diversity and variation and tracing it properly and getting it correct. So the top line is the truth. The blue line is flawed and misleading. Some of you may be asking, well, what do you do with the unprofitable products on the right side? Do you abandon them and drop them? No, that could be a mistake, because some companies deliberately have what are called loss leaders, but they're associated with winners like blades and razors with shaving, But at least the top line is fact-based data. And if you remember anything from this webinar, remember this: in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of your boss or the boss of the boss. So to the degree that the executives at the top are making decisions on intuition or gut feel or their so-called sixth sense or flawed and misleading information like the blue line, your organization is vulnerable and at risk to go bankrupt. Here's another graph, same different organization, even more extreme. It said you made roughly $5 million on 60% of your product. You lost and were unprofitable for the rest. Incidentally, these two graphs were my first projects with KPMG in 1988. They are almost 40 years old. And yet still so many organizations are not using ABC. They're getting that blue line. There's a lot more visibility that meets the eye, and any one of those data points, each product is reaching up into the work activities and asking how much of each of you that I uniquely consume, and it piles them up like pancakes, where the thickness of the pancake reflects the quantity of the activity driver times what's called the unit cost driver rate. So this way we get visibility and transparency that's hidden with that butter spreading traditional standard cost system. I love this cartoon. You have this signpost that says answers. To the left, it says simple but wrong. The right path, complex but right. Notice how many are taking the left path. And I would submit probably 90% of you listening to my webinar, you're taking that left path. You're allocating that overhead. Oh, it reconciles exactly, which satisfies the external compliant statutory audit, but it's wrong in the parts. So, and notice at the end of the cliff, they're falling off. The organization's going bankrupt. We need to get more people to take the right path. Now, a way to do it is called rapid prototyping with iterative remodeling. Now, I know many of you listening to me were saying, well, Gary may be persuading us to do activity-based costing. However, it would be a mudslide of data. Every employee would have to fill out a timesheet. There'd be 3,000 activities in that model. IT would have to extract the data for all of the inputs to the driver data, and on and on and on. Those are misconceptions. But that was the problem with ABC 20, 30 years ago. People over-designed the models so big, so complex, they were unsustainable. They couldn't be refreshed. No one could understand them. And so ABC got this bad reputation. It does not work. It does work. It's just full absorption costing done correctly. So the fast way to implement it, and I can train and transfer the knowledge how to do this to anybody in Sri Lanka. I've done this with A.N. Rahman and several other consulting firms in India and Sri Lanka. You start with a one-day workshop with 5 or 6 cross-functional employees in the room. That's model 0 to the left. Then, and you build the model very quickly, high level. The intent is not any useful or accurate information. The next day you bring in the line managers and the executives. They see what was built. It's very engaging because it's your own company, and the light bulbs go on with everybody. Oh, that's how we could better, not butter spread, but see accurate profit margins. Oh, that's how we could basically do benchmarking with apples and apples. Oh, it's accelerated learning. They get it. Then for the next couple of weeks, you decompose the model, make it a little deeper, start replacing some of the percentage estimates with extracted data. And within 3 weeks, look what you've got, a permanent, repeatable, relevant, reliable ABC system. Make your mistakes early and often, not later when the system is too hard to change. The reason rapid prototyping works has to do with this slide. The vertical axis is the accuracy of the final cost objects. The horizontal axis is the level of administrative effort to collect the data, validate the data, calculate the data, report the data. You'll always get an asymptotic curve that goes up relatively quickly, and then as it goes to the right, diminishing returns on extra accuracy for the extra level of effort of work. And so now look at this slope of this black line. That's what rapid prototyping gives you. It goes up really quickly, and then when you get to the top, stop there, 95% accuracy, good enough. Remember, this is not compliant statutory reporting for regulatory agencies. Yes, if you get those numbers wrong, you go to jail. But if you get management accounting numbers wrong, you don't go to jail. So it just needs to be reasonably correct so people can start using it. That's why at the bottom I say, is the higher climb worth the better view? Benefits from rapid prototyping, accelerated learning, people get it. Solving the thorny leveling problem. You know, you're wondering, are we going to have 500 activities, 1,000 activities? No, it right sizes itself, typically 50 to 70 activities. It prevents that over engineering, which was the problem ABC failed. And then finally, peer group, predetermining the uses. At the end of that second day of the workshop, you ask each of the managers who invited in, once this system is live in 3 weeks, how will you use it? What decisions will you make? Oh, I'll do pricing validation. Oh, I'll do this, I'll do that. We're getting them to commit to the use of the information. Now, let's talk about channel and customer profitability, was the title of this webinar. What's really caused interest and is increasingly causing more interest is not just product and service line costing, but all the way to customers. The shift from being product-centric to customer-centric. The emphasis will be more on economics, measuring customer profitability, and for business to consumer, customer lifetime value, which I don't have time to talk about in this webinar, but if you're interested in CLV, go to my website, one of the rows, tab down, and you'll see an article I've written on customer lifetime value. So here's the issue. The value of any company is a function of the value of its customers. The only value a company will ever create is the value that comes from its customers, the current ones and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, and serve them more efficiently, and acquire relatively more profitable customers like your existing ones. But there's a few problems here. The CFO and the accountants are not calculating customer profitability. Or if they are, they're doing it with a flawed, butter spreading way. They're stopping halfway at the product gross profit margin line. And here's the point. Customers are the source of value creation for shareholders and owners. And look at the back screen of the ICMA, value creation. That is what we're talking about here. So what about all the below the line calculated cost? Products and standard service lines are not the only thing for which accountants should compute costs for. What about all the costs that have nothing to do with making products and delivering standard service lines? The problem with traditional accounting's product gross profit margin reporting is you do not see the bottom half of the picture. You know, that bottom half below the gross profit margin line, selling expense, marketing, customer service. And I'm going to make a case now in the next 5 minutes why the bottom half of a P&L is more important than the top half. Because here's another point. Today, customers view suppliers as commodities. They all provide the same thing. Therefore, for a supplier to be competitive, they need to provide differentiated services to different segments of customers. And not all of them are doing it well. Visually, if we have an income statement fictitiously that says, okay, here's the sales 100, direct product cost 20, indirect 10, gross profit margin 70. And it'd be nice if the indirect was based on ABC. But look at when we bring in selling, distribution, marketing, administrative, that 70 gross profit now becomes 10. There's no visibility to that difference. ABC will make the visibility. Visually, what I'm saying is if the entire rectangle is the expenses for a period, let's say January, the shaded part is only the product and standard service line. Material, labor, equipment. Be nice again if the indirect was not butter spread, but using ABC. But what about when we bring in the distribution, including the channel? And what about when we bring in all of the cost to serve to the customer? What I'm saying is the white space in this rectangle is more important than the shaded space. And why? Let me give you 4 reasons. I call this the perfect storm. Number 1, customer retention. It is relatively much more expensive to acquire a new customer than to retain an existing one. Well, that's kind of a no-brainer because if you understand decision theory, only consider future decisions the impact of things that will change. And existing customers are a sunk cost. You've already acquired them, so they're not relevant. Next, sources of competitive advantage. As I already mentioned, as products and standard service lines become commodity-like, then the shift is towards service differentiation. Next, customer relationship management, one-to-one marketing. In the marketing world, there are 2 faculty members, Don Pepper and Martha Rogers. You can read some of their books. They have hailed technology as the enabler to 1, identify customer segments, and 2, tailor the marketing offers and deals. In other words, work backwards, knowing the unique preferences and characteristics of customers and their tastes and desires, and then tailor the price discounts, the coupons, the offers to them. And finally, number 4, the power shift. The internet is shifting power irreversibly from sellers to buyers. And I don't mean you at your household purchasing things on the internet, for your family. Today, in a company, purchasing agents with a click of a mouse can see 10 suppliers and all of the information about them. And the internet is a one-time event happening in our lifetime. So if you put these 4 factors together, what it means is we really need to know the distribution, selling, marketing expense, and so forth. Now comes this problem, angel customers and demon customers. What do I mean? Every supplier will have high maintenance customers and low maintenance customers. Examples of a high maintenance customer, always changing the delivery schedule, never buying standard, always special, always calling the help desk, always returning the goods. Angel customers, low maintenance customers, you love them. Only buy standard, never change delivery schedule, never call help desk, never return goods. If those 2 types of customers bought the same volume, same mix, at the same price, they are not equally profitable because the high maintenance customer is causing you a lot of extra costs, so they're less profitable. But what caught my attention about this book was not its main title, the subtitle. Discover which type of customer is which and turbocharge your stock price. And so this is the message that we need to connect customer value creation. They're the source of value creation all the way to shareholders and owners. Incidentally, this book was published by marketing faculty at Columbia University, and it doesn't really talk much about management accounting. So I've decomposed the multi-stage cost assignment network. I'm not going to walk you through it, but you see the drivers are coming from left to right. But what's happening when you model this is as the activity costs come in, the profit contribution is being eroded layer by layer by layer. And with ABC, boom, you get a profit and loss statement for each customer. And because it's layered like an onion skin, you have a lot more visibility of the profit margins. So in this fictitious example, notice for the product and services, it's a 30% composite profit margin. And it's a composite average because some company may be buying some products up higher than 30, lower than 30, but on average it's 30. But note between the 30 and the 8, 22 more points of profitability are gone, eroded, nothing to do with the product and services, all with the channel, selling, and marketing. And if you calculate this for every single customer, just the two swaths, you can put them onto a grid that looks like this. Each circle intersection is a customer. The vertical axis is the product mix gross profit margin for what they buy. The horizontal axis is the cost to serve, those angels on the left, the devil high maintenance on the right. And now things become very obvious. The most unprofitable customers are in the bottom right because they're buying low profit margin mix from you and they're difficult to serve. The most profitable customers are in the upper left of the box because they're buying high profit margin mix from you and they're easy to serve. And now the name of the game is move the dots from the bottom right to the upper left. And that will require actions done with marketing and sales. Incidentally, in the US, a few organizations that have ABC are changing the commission structure for the sales force to not just be an incentive based on 100% sales. That's typically how salespeople get their bonuses, but a blend like 60% sales, 40% customer profit. And when the sales director has what's called their account planning meetings, then they create a target for both. And so now what we're doing is we're motivating the salespeople to alter the behavior of the customers in harmony with the expense structure. So we're getting them to, if you will, connect that the customer value creation to shareholders. Here's another way of looking at similar data. Now the circles are squares. The horizontal axis is the sales volume. The vertical axis is the profitability of each customer. Notice the largest sales customer is to the right, but above that is a few customers, less sales, more profitable. But the triangle at the bottom, those are sizable sales customers and they're unprofitable because they're those high maintenance. The message is this: sales volume is not synonymous or representative for profitability. Now, what's really happening is there needs to be a shift in the CFO's emphasis. Typically, what the CFO does is pound on the operations people to get their costs down so there could be more profit. They've got to shift their attention more to help the sales and marketing to better target customers. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits for shareholders and owners. So this means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back, and which types of customers are not attractive? And then for the customers that are attractive, the next question is, how much should we optimally spend attracting them, retaining them, growing them, or recovering each customer microsegment? And the reason I have optimally in italics is because it is an optimization problem. Why? Remember the subtitle of the Angel and Demon Customers book? Discover which type of customers which and turbocharge your stock price. Well, here's the point. You can destroy shareholder wealth in two ways. You can do it firstly by overspending unnecessarily on loyal customers for what is needed to retain them. In other words, they were going to purchase the same volume and mix from you, regardless how much you wine and dine them or give them extra attention. But you can also destroy shareholder wealth by underspending on marginally loyal customers and risk their defection to a competitor. You know, that they're not loyal to you enough. So, oh, they're not basically paying attention to me. I'm going to go buy the same stuff from a competitor. The point is this, therefore, what is the optimum spending level for differentiated services, price discounts, coupons, offers, deals for different micro segments of the customers? The CFO in the accounting department has an obligation to provide this information to their marketing and sales. But again, very, very few of them are doing that. Other factors that involve can be retention, loyalty, attrition of the customer. Sometimes companies will go to the customer master file and what's called recency, frequency, and monetary spend. How often did they buy? What did they buy? You know, but there are also factors like the life cycle of the customer, their referral potentials, you know, that if they like your services, they'll tell another company, family relationships, mothers, daughters, social networks. You get the idea. Now, real briefly, what are some of the action steps that can be taken to improve the profitability of a customer? Well, you can basically somehow maybe try to be more efficient with the cost to serve. You can improve and streamline customer-facing processes. In some cases, what you can do is put a surcharge. In other words, unbundle those extra special activities at the high maintenance and charge them individually. The banks have been doing that with deposits. In the US, the airlines have been charging for baggage, or if you want to be in a aisle seat, you got to pay more. You can reduce the services, you can introduce new products and service lines. You can raise prices to be profitable, but you then risk them going to a competitor. Streamline those internal business processes. Also offer customer profit positive service level options with varying prices, you know, like Federal Express or DHL, you know, the transport companies. If you want one-day delivery, you've got to pay an extra price. You get the idea. Now, I do want to briefly touch on the historical view, because when you're doing customer profitability, which is very valuable, in reality, it is looking through the rear view mirror. It's descriptive costing. It's what happened last month, last quarter, last year, which customers are more or less profitable. But as I mentioned in my what, so what, then what, 3 questions, the third question was, then what? And what I said then is all decisions only impact the future. Therefore, when you're looking at the future, you should only consider costs that'll be variable. So there's my then what. And this now involves price quoting, because when you're thinking about, all right, we got a new product or a new customer, how do we set the profit margin that we want? Well, we better at least know what's going to be the cost of the middle line. You know, remember, top line sales minus middle line cost equals bottom line profit. It's a derivative of the top two. So I want to give you an overview of a chart that I created for IFAC. You know, I believe Lakshman introduced in my introductions that I've been very involved with the International Federation of Accountants. They're in New York City. They are like the United Nations of Accounting Institutes. I think there's 180 global ones. And I said, I can create this taxonomy, you know, just like in biology, animal kingdoms, plant kingdoms, okay? And so here is my taxonomy of the big world accounting. There's like 3 kingdoms: tax accounting, financial accounting, managerial accounting. And I want to make a point with this before I put in more. Expenses and costs are not the same thing. Expenses are when you exchange money with third parties or pay employees, you know, like currency exits the treasury, okay? It's like writing a check. All costs are calculated. So a process cost, an activity cost, a product cost, we're calculating those costs. So we start with cost measurement. When we go to the left, we're now basically in the world of the financial accounting. Remember the statutory external reporting. In that area, we follow rules. It's typically called Generally Accepted Accounting Principles, GAAP. External reporting is primarily about valuation. You know, things like in manufacturing, inventory value, cost of goods sold. But for internal management accounting, we don't have to follow the rules. We can deviate with those simplistic rules for the regulatory agencies and basically model it the way I described. So external reporting is about value, is about calculating value, if you will, valuation, but internal management is creating value. Remember the slide, the quote that's in the back of the ICMA screen, creating value. And when we do that modeling, historically looking back, we can get budget variance, we can get the profitability reporting that I just described here. But when we go to the predictive view, now we're going into the future. Now we're doing things like driver-based budgeting. And this was my previous website or webinar for the ICMA, and I believe it's archived. So if you want to go back and visit it, I encourage you to. Driver-based rolling financial forecast, what-if scenarios. But the point to this slide is look at the bottom. I have the value spectrum. Low value add to the left. Then when we move to the right, modest value add, which is the strategic profitability reporting, and then high value add to the right. The highest value actually comes from the decision support and cost planning, which again was my previous webinar. Sometimes the CPAs, the chartered accountants in the United States, they don't like me when I show them this diagram. Why? Because what they're primarily doing is closing the books and doing the statutory reporting for the regulatory agencies like in the United States, the SEC. And I've mentioned this in my previous webinars, I'll say it now. There is a problem in India and Sri Lanka, and I think some of the other Asia Pacifics. There is far too much emphasis on external reporting for the regulatory agencies. You need to provide more information and better information internally to the executives, to the line managers and the employee team so they can make better decisions to improve the profitability for the shareholders and the owners. You know, who's more important, the regulatory agencies or the shareholders or the owners? But it does get tricky when you go to the predictive view, because in the historical view, the big box are saying, we don't really need to care about costs being fixed or variable, any of that. It happened. Basically, it's history. But when we go to the predictive view, next week, next month, next quarter, next year, we need to classify the behavior of the resources and their adjustability of capacity as sunk, fixed, step fixed, or variable. And the problem is the classification depends on the planning horizon, because in the very near term, most capacity is fixed. You know, you're not going to basically lay off employees because there's not enough orders in the house to make, and then you hire them back on Wednesday when there's more orders. So on that Tuesday, the day before, you would just incur some unused and idle capacity. But as we go out weeks, months, quarters, years, we might replace full-time employees with temporary contractors. We might lease assets that we normally would have purchased. So it increasingly becomes variable. So you really need to think like an engineer. That's what I tell a lot of people. You remember, my beginning was industrial engineering, my degree, but at age 27, I was a division controller, and I've been in the CFO accounting space ever since. I'm 71 now, but I still tell everybody I'm an engineer masquerading as an accountant. You got to think like an engineer. The predictive view is really like microeconomics. Now, if you're interested in knowing, well, what stage of maturity might my organization be, this might be helpful. This is another document that I created for the International Federation of Accountants. I know their staff in New York City fairly well. And after I created that taxonomy diagram, I mentioned them, I can create a stages of maturity model that any organization can assess. Where are they at? Which stage? Or a consulting firm. And if you are a consulting firm listening to me, send me a message because I can train you how to do this assessment. Now, here is the diagram. Don't be shocked. It doesn't have the traditional 5 stages of maturity. Everybody says, oh, you got to be 5. This has 8 for the historical view. I have empirical evidence that the vast majority, 95% of organizations are a stage 5D or lower. They're doing that traditional standard cost accounting and spreading the indirect expense like butter across bread. 6D is when you move up to at least doing activity-based costing for just your products and standard service lines. 7D is the next stage up, which was what this webinar was about, going below the product gross profit margin line to do customer profitability. 8D is a little trickier if you really wanted to calculate unused capacity. I don't particularly encourage that. Unused capacity, typically you can see visually when workers take longer lunch breaks or slow down. The right side is the predictive view. There's not enough time to talk about it, but most people are really, when they're doing their budgeting, they're using spreadsheets for each cost center statement and consolidating them, and management gets the first set of numbers. They don't like it. And then you got to redo the spreadsheets, up, down, up, down. You don't want to use spreadsheets. You want to do driver-based budgeting and rolling financial forecasts. Calculate that model backwards. Forecast the volume and mix of the forecast, multiply times those unit level cost consumption rates to solve for the level of capacity, the number of employees and their salary and wages. It was industrial engineering 101 for me at Cornell. Volume and mix times unit level consumption rates equals capacity required. So to start concluding, what's really happening in organizations is there is a shift from the return on investment from tangible assets to intangible assets, meaning the shift is from buying trucks or machines or computer hardware or software, those are tangible assets, to an intangible asset like information. And you'll notice from this diagram at the left, as you go from data to information to knowledge to insights to decisions, the return on investment from information increases exponentially. The problem is many organizations are stuck in the first 2 red bubbles to the left. All they have is raw data and standard reports. You know, they may have a large ERP systems. I'm familiar with all of them. In India, of course, SAP, very dominant. In some cases, the chief information officer, the IT director, will give some of the managers what we call drill down software, acronym OLAP, online analytical processing. Examples of those software are Click, Tableau, Microsoft Power BI. But when managers get all 3 of those, all they can answer is what happened. When we move to the first blue bubble, now we are into the world of corporate performance management methods or enterprise performance management. They're synonymous. It's modeling. Remember, I said costing is modeling, the multi-stage cost assignment network. It's not T accounts and journal entries. Now, we not only can answer what happened, we can answer why did it happen, because we have visibility to the driver quantities. Now, when we go to the predictive view, now the future is coming at us. We can forecast the volume and mix that customers may buy from us. We can do sort of that what if projections, remember the sunk fixed variable stuff. Now we not only know what happened, the first blue bubble, why did it happen? what can happen, what are all our options. We can do, if you will, sensitivity analysis. We can increase projections of sales 5%, decrease it 5%, do what if scenario analysis. Very helpful, insightful. At the top, we're at what I call Mount Everest. Of all the choices you could make, what is the best choice? The data scientists call this prescriptive analytics. It's really optimization. So how does it all fit together? This is a diagram that I created. I'll walk you through it in just a minute. The big box is your organization's assets. It's your employees and it's your assets, okay? I'll walk you through how these boxes work in a second. But what we want to do is notice customer box satisfaction. The arrow goes left all the way to shareholders. This was my earlier phrase. Customers are the source of value creation for shareholders. We need to connect them. Where's management accounting and analytics in my diagram? I didn't put it in there because the output of management accounting is the input everywhere to so many different places, including analytics. Okay, how does the diagram work? We start with the customers, and the strategy and mission will be formulated by the executives. That's their job. Set direction. Where do we want to go? They will then traditionally communicate it to employees and managers in a way they can understand it with the strategy map and the balanced scorecard. That's the work of Professor Kaplan and Dr. Norton mentioned earlier. I was also very fortunate to be involved in the beginning development of the balanced scorecard. Once employees basically have targets and KPIs every day, they can turn on their computer screen, look at the screen, the dial, is it favorable or unfavorable to the target? They can answer the question, how am I doing on what's important? And when every employee can do that, everybody can say, how are we doing on what's important about strategy execution? Now comes what I described in this webinar, the whole targeting of customers. Remember which type of customer is most attractive to retain, to grow, to win back, to acquire, which type's not, how much should we spend? That's the information the CFO and the accounting department needs to provide sales and marketing so they can better target the best types of customers. Now comes process improvement. Notice I have this circle. The most universal end-to-end business process in any organization is order fulfillment. Accept the customer order, complete the order. So this is going to be the operational process people. This is going to be the world of lean management, Six Sigma quality management. Typically this is where the enterprise resource planning tools, transactional come into play. So the idea here is the shareholder wealth creation is not necessarily, well, it is a goal, but it's really a result. And I hope that you're seeing these white bubbles flowing through. This is what's happening in any organization every minute, hour, day, week, month, year. But the challenge is if any of these veins, think of these like the vein in your body, from your heart through your blood system. If any of these veins is constricted, I call that arteriosclerosis of your performance management system, then the money isn't going to completely flow through to the shareholders. Look, it's going to leak into the sewer. So to the degree that there are inefficient processes, poor targeting of customers, unprofitable customers, selling unprofitable products, the money doesn't optimally go to the shareholders, it leaks into the sewer. So I'm hoping you look at this slide as like a vision of where you want your organization to be, not 5 years from now, not 3 years from now, but 1 year from now, maybe 9 months from now. And the way to do it quickly is rapid prototyping with iterative remodeling. Implement these methods. I also have, which I didn't describe here, how to implement balanced scorecard and strategy map in 1 day. And if you want to know more about that, I think it's in my website. Read the article on strategy map and balanced scorecard. Now, my big frustration. Why has the adoption rate for profitability reporting with ABC been so slow? Well, some of the barriers are these. Technical barriers include IT-related issues, such as what's called dirty data or low-quality data. But the information technology department and the chief information officer, they have tools that can cleanse and purify the data. One is called extraction, transform, and load, ETL. Also, some companies have different hardware. They've got Dell equipment, Hewlett-Packard equipment, IBM equipment, so it's disparate. IT can solve that. The next problem are the perception barriers of excess complexity and affordability. Earlier in my presentation, I said to you, some of you, probably many of you are saying, well, Gary's convincing me we should do ABC to get rid of the flawed and misleading information. But you are still thinking it'll be a mudslide of data, every employee filling out a timesheet, 3,000 active, all of that. And I demonstrated to you, it can be done in 3 weeks. So it's not that complex and it's easily done. The big problem, it's got nothing to do with software or methodologies. It's all behavior, people. It involves resistance to change, culture, and leadership. And what I mean by resistance to change, it's human nature. People like the status quo. I like to say only babies like change of their diapers. Also, fear of knowing the truth or fear of others knowing the truth. Maybe some managers don't want everybody else in the company to know which customer is more or less profitable or which products are more or less profitable. They have selfish reasons to want to keep that secret. Other barriers, fear of being held accountable, fear of being measured. Like, oh, I don't want to be measured. I don't want anybody to know of these barriers. And then I'll say it, weak leadership. Not every company has high IQ in the executives at the top. And I think, as I recall, Lakshman at the beginning, when he was introducing me, was saying many of the executives in India, Sri Lanka, and some of the other Asia Pacific, they haven't basically bought in, or they're maybe not aware of activity-based costing and measuring not just product and profitability, product and service line, but the channel customer all the way to customer profitability. So you've got to basically behave like a change agent. And none of you have degrees in sociology or psychology, I don't think, but you've got to start thinking, how do I basically get buy-in? And the action steps, notice the first one, get educated. Well, you're doing that right now by listening to this webinar. Thank you very much. But you've got to get buy-in from the executives, line managers, and employee teams. Rapid prototyping, start small, think big. Improve incentives. I do not have expertise in motivational theory. I just know it's important. The link under the resources is an article that I wrote for the IMA Strategic Finance Magazine. And I think that the ICMA, when they provide you the PDF, these slides, may give you the PDF of that slide, of the paper, so you can read it. So your success depends on how well and how fast the right information, intelligence gets to the right people. So there is my email address. You're welcome to send your questions to me, although it looks like, Lakshman, we've got 6 minutes for questions, but we will end exactly, it's a professional courtesy to end on time, or put your questions in the chat box and someone from the ICMA will copy them into a Word document, send it to me, and I'll answer them in 48 hours. So I hand it back to you, Lakshman.
Thank you, Gary. I think let me thank you for that very, very detailed description that you had. I think you went through all the points that were there, the ABC, which I think we listened earlier also, and then of course on the customer profitability and how to go forwards. So since time is very short, I would ask Dr. Nuwan to make a few comments, and thereafter Mr. Hennaka will give the vote of thanks. So can I invite Dr. Nuwan? I think there's no time for questions, but maybe you can make a comment and thereafter we will go forward, right?
Yes, thank you, Professor Vattabala. Now for the participants, my request is now, since we have very limited time, please contact Gary directly so that he will answer your questions. And yeah, we have only one question, so I'm sure that you can contact Gary for the direct questions. Now, quickly, in the best interest of time, let me summarize what we have been doing for the last couple of seminars. As Professor Vatavala and Mr. Gary mentioned, in Sri Lanka and even in South Asia, there's still high tendency to follow financial accounting practices, so financial reporting aspects, at the expense of management accounting, especially focusing on the value creation aspect of management accounting. Now, this is, as you mentioned, this is the predictive use of management accounting. Now, during the last few seminars, we actually highlighted the importance of using management accounting for various purposes, not only for controlling, but even for decision making, then performance evaluation, and even for other purposes. So therefore, I think these seminars, including today and the previous 3 seminars, are not only value adding, but also they are really eye-opening on the need to use activity-based management and activity-based costing principles, especially to overcome these technological, perception, and organizational barriers. And I think, Gary, you mentioned something very important. So this is not about technical matters, it's about behavioral measures. So the challenge would be to get the people on board, the top management on board, to get into ABC. So that's, I think, which we will have to deliberate in the future discussions. Thank you very much.
Thank you, Dr. Nuan. So may I invite Mr. Hennaka Bandara to propose a vote of thanks.
Thank you, Professor. Ladies and gentlemen, on behalf of CMA, I'm glad to propose this vote of thanks after a successful webinar conducted by Gary. As mentioned by our president in his welcome speech, Mr. Gary is not a stranger to CMA. He has helped CMA in the past in numerous ways in conducting CPD programs. With that note, I would like to thank Mr. Gary for his insightful presentation and sharing his experiences to educate us mainly on measuring and managing customer profitability. I'm confident that the guidance provided by him will assist all of you to enhance your knowledge and skills. Let me also thank Dr. Nuan Gurratne joining with us from Australia and for his valuable contribution. I also would like to thank Mr. Raman, our advisory council member, and all our council members for their participation. Let me also thank our president for his guidance and organizing this webinar under the CPD program to improve the skills of our members and others. Finally, I would like to thank all our members of SAPA member bodies and others for your participation, and the CMA team for the support extended to conduct a timely, important webinar. Thank you. Stay safe.
Thank you. Gary, we will pose for a photograph. Can you kindly, all of them, open up the video? Mr. Raman, I don't know if he's gone off. Mr. Naranguda. Okay, we will pose for a photograph.
Okay, sir. Thank you, sir.
Okay, thank you, Gary. I think we are very grateful to you for your presence, and we are very happy that we've been able to bring you into our CMA Sri Lanka, where you are now a fellow member. So we are very happy that you have accepted the fellowship, and for the very excellent presentation you did. And I'm sure that we can build the management accounting profession, as I said, and give the value creation that we are talking of. I think that's the most important thing. So let me thank you once again on behalf of me and the council and the members. Of course, Dr. Nuan is also here, who has played a major role in this. So once again, thank you very much and wish you all the very best.
You're welcome. And it's a privilege to be associated with the ICMA. Thank you very much.
Thank you.
Thank you, Gary.
Thank you.
Dr. Nuan. Thank you, Professor.
Thanks,
Thank you,
Nuan.
Professor.
Thank
Thank
you.
you, Gary.
Thank you then. Okay.
Thank
Thanks,
you.
Ajendra.
Thank you.
Thank you.
Thank you,
Okay,
Mr.
then.
Mayor. Bye.
Good night. Good night, all
Right.
of you.
Thanks. So we will close and we'll meet again till we meet again. Okay. Thank you and
Thank
bye.
you.
Okay.
Yeah.